I'm Wayne Harper, State Senator from Utah. I have with me Craig Johnson, the Executive Director of the Streamlined Sales Tax Governing Board. I have been involved with remote sales tax and tax simplification since November 2000, attempting to go through and work with other states, including West Virginia, as well as members of Congress in order to go through and pass a piece of legislation that would return back to the states the sovereignty and control that we had over our sales tax policy that was removed by the previously referred to Bellis, Hess, and Quill decisions from 67 and 83. I have been doing this as a delegate, again, since November of 2000. I have served for many years as the chair of the House Revenue and Taxation Committee, and later on in the Senate as well. Myself and a couple others worked and did exactly what you are doing here. We took a 4-year project and went through every section of our tax code and made some minor changes in areas, and in other areas such as corporate and individual income tax, we did major changes in that, insurance premium taxes, the whole bit, in order to go through and make it easier to go through and understand and comprehend. So I commend you for what you're doing here. It's a daunting task, but when you're done, you can look back and say, you know, you made a difference. With that, we're here to go through and talk about what we're doing here. There's a lot of stuff that's going on right now with Congress. We'll get into that a little bit better. Before redistricting, Representative Jason Chaffetz was my member of Congress in Utah. He's introduced the Remote Transaction Parity Act. We have a companion piece of legislation in the Senate, the Marketplace Fairness Act, sponsored by Durbin, NC Alexander, and Heitkamp. There's a lot of action on those things. We have seen a significant amount of energy and change in that this year, more than I've ever seen in the nearly 15 years I've been involved doing this. Was in the House, served in the House for 16 years, and now in the Senate for 3 years, and I really love this process. With that, we have a presentation that Executive Director Johnson's going to do, and then if you have questions, hopefully you ask those, and we'll reserve some time at the end to go through specifics.
Thank you, and I, like Senator Harper, I appreciate the opportunity to come and talk to all of you about streamlined sales tax, what we're doing, what's happening at the federal level, what we're doing to support that, what we're also doing to support you as one of our member states. As hopefully all of you are aware, West Virginia is one of our 24 member states. We're glad to have you, and you're going to do everything we can to keep you as long as we can. My background, just to have some quick history on me, I worked for the Wisconsin Department of Revenue for about 23 years before taking a position here as the Executive Director. When Wisconsin joined Streamlined, they went through the same process that West Virginia did, which is trying to write your laws so that they conform to what's in the agreement. At the same time, trying to maintain a revenue-neutral position. And we think that we were successful in doing that when Wisconsin joined. As the agreement has evolved, and it's been amended a number of times since it's been adopted, state legislators have had to go back, and the legislatures have had to go back and make some additional changes to the law. One thing to keep in mind, and we'll talk about as we go through, is that the whole Streamlined Sales Tax Agreement and the governing board and the project itself is a cooperative effort, not only between the states and the legislators and the tax administrators, but also with the business community and the tax practitioners. It's that partnership and that cooperative partnership that really has led Streamlined down the path that it's gone and has made it as successful as it is and as long-lasting as it is. So with that, when we go through the presentation, what we're going to talk about, just a quick agenda. We'll talk kind of about the big picture about remote sales. We'll give you some background on Streamlined. I know some of you are very familiar with it. Others of you may not be so familiar, so we'll walk through what the key features of the agreement are. We'll also talk about some of the things that you need to keep in mind to stay in compliance with the Streamlined agreement when you're looking at changing your state laws. You know, one thing that I stress, and I know Senator Harper would stress the same thing, is Streamline's not about telling you what you should or should not tax. Streamlined it wants to give you, as the state legislators, wants to give you the sovereignty that you need to decide what you want to tax and what you don't want to tax in your state. We get into some uniform defined terms and things like that. We're going to ask you to either tax everything in a category or nothing in the category. That's the extent of it. So we will talk about those, and then we'll also talk about the federal legislation itself, where it stands, where we see it going, and hopefully what all of you can do as well to help get that moving along at the federal level. So let's start out just with the kind of the big picture with respect to remote sales. So we all know e-commerce is continuing to grow. It's growing in double digits every year. And it's just the more it grows, the more people get comfortable buying things online, the harder it becomes for your local brick and mortar stores to compete. Unfortunately, and we heard some discussion during the last presentation where they were talking about customers going into a store, looking at a product, and then they turn around and buy it online. We refer to that as showrooming. It used to be that people, when they would do showrooming, they would say, you know what, I can buy this online for $500 less, can you match the price? Or for $100 less, can you match the price? Now what we're hearing is not only can you match the price, but because consumers are aware that they are supposed to be paying that use tax, although many of them don't. In fact, I would guess that the compliance rate on use tax by consumers is probably something in the area of 1% to 2%. It's very, very low. But now, because consumers are, at least they're aware of it, they're now asking those retailers not only match the price, but match the price after you pay the tax. So they're really asking that brick and mortar retailer to take that tax out of their pocket as opposed to the consumer paying it, which is the way the sales tax law is set up. So because of that, you have your local merchants, they suffer from the lack of a level playing field. They have to compete with companies that are selling the same product that don't have to charge a tax. That can be anywhere from a 5% to 10% difference, depending on where the competitor is located, what state the brick and mortar store's in. The other thing that we find is, with respect to remote sales, is it gets into the compliance with the sales tax law by multi-state corporations and how complex that is. And that really goes back to National Balance Test. It goes back to Quill Corporation that says, look, you can't put undue burden on interstate commerce. And because of the complexity, that is that undue burden. And that's really one of the things, again, that Streamlined is looking to overcome. Now, as far as the burdens themselves, so what are the things? Again, I mentioned that this Streamlined was a cooperative effort with the business community, with the tax practitioners, state legislators, and tax administrators. But you find out from the retailers that what are the things that do make the current system so burdensome for them. You get into the state and local tax administration of states. Some states have the states administer some and the local administers some. You need to have a central administration. Otherwise, you have two different groups interpreting the same language, and they come up with two different answers. What is the retailer supposed to do in those situations? There's unclear rules on who has a right to tax a transaction. We refer to that as sourcing transactions. You know, does state X, are they entitled to the tax, or is state Y? We'll talk about some of those rules. Too many tax rates within each state and locality. Now, years ago, I would say this was a bigger problem than it is today. Today, you have the technology that's out there. I can tell you that in our 24 Streamlined member states, we have over 4,300 taxing jurisdictions that are covered. And I can tell you that our certified service providers, another term we'll talk about later, they can compute the tax properly for all 4,300 of those state and local taxing jurisdictions. So that's less of an issue as it was in the past because of the technology. We also talk about different state and local tax bases. There are some places, some states where the state may tax an item, but the local government may exempt it, or vice versa. The business community really believes that you need to have the same tax base. Either everybody in the state taxes it, or nobody in the state taxes it. Some other things that make the whole system burdensome, the same word means different things in different states. Let me just give you an example that just came to light recently. I was at the SSUTA conference, and they were talking about the state of Louisiana, and they have the local administration of their local taxes. The parishes administer them themselves. And a taxpayer had gone to court, had won their decision in the state court, but the local jurisdiction was still saying, no, that's not the right answer. And they wanted to have to fight that court, or that case a second time when you're dealing with the exact same terms. So it's important, again, to have that central administration. Next thing deals with retailers being liable for tax when a business or a purchaser lies, or they fail to provide proof of an exempt sale. Most states, and I believe West Virginia does as well, have a provision in your law that says that when a seller makes a sale, it's subject to tax until they can establish the contrary. And many times the contrary is a purchaser providing a tax exemption certificate. But Prior to Streamlined, many states, my own state, Wisconsin included, we had what we called a good faith provision. We told the retailer, well, you need to ask more questions of that purchaser. You can't just exempt it because they say it's exempt and because they give you a piece of paper. So you're asking each retailer to know what every one of their customers' businesses are and what they're all about, what things they should be able to buy exempt, what things they shouldn't. That was a burden that retailers point out, so that is very difficult. We'll talk about what Streamlined has done to address that and how it has worked in our Streamlined states. Returns in each state require different information. And again, you're talking multi-state businesses. You have many businesses in West Virginia that are going to be solely West Virginia businesses. But you have a lot of West Virginia businesses that are selling things throughout the country. And because they're selling the things throughout the country, they need to know what each state requires with respect to their returns. So we're looking for some uniformity in that area. Same thing with respect to registering. Obviously, businesses have to register to be able to collect tax. And having to register in each state separately is burdensome and time-consuming for the states or for the businesses. So really what it comes down to, we have complex systems, we have an unlevel playing field for your local brick and mortar stores, and we got a lot of losses of revenue that are anticipated. Back in 2012, there was an estimate that was done by the National Conference of State Legislatures. National Governors Association, Streamlined, participated in that as well, and it was estimated that there was about $23 billion lost by the states in untaxed remote commerce. That's tax that in many cases was legally due an owing, but is not collected because the purchasers failed to self-assess the tax. So identifying those problems and saying, look, there's something that we need to do, what is it? And the need, as it's indicated on there, we needed this cooperative effort. We needed the tax authorities, we needed the business community, we needed all those people involved to come up with some way of simplifying the sales and use tax administration throughout the country. So how do we do that? 1999 really is where Streamlined starts. National Governors Association, National Conference of State Legislatures, who many of you are probably members of and involved with. They went to the tax administrators and said, look, we need to develop this system. It's got to be these three things: less complex, has to address the unlevel playing field, has to talk about the loss of revenues and what we're going to do that. So these groups recognize the problem early on, move forward with what now is the Streamlined Sales and Use Tax Agreement, but at the time, we had 44 states, DC, Puerto Rico, they were all involved. Now you might say, well, why weren't all 50 states involved? We got 5 states that have no sales and use tax. Those 5 states, they had no interest in this at that point in time. Colorado also had some issues with respect to what they call their home rule, the way their local jurisdictions were set up. So they also moved away from participating in the project early on. And to this day, they have not been a participating state. All the other states with sales and use taxes have been and are continuing to participate. We also have the local governments involved, tax practitioners, and again, most importantly, I think, the business community, because they are out there on the front lines on a daily basis. They know where the complexities are, and they know where there's areas that we can look at improving and making things a little bit simpler and easier. So when Streamlined started, these were kind of what the goals were. We wanted a simpler system. If you couldn't make things simpler, at least make them uniform. If there's at least that uniformity from state to state, that's a big step. We also had to be very, very cognizant of the fact that you had to balance the interests of the state sovereignty with issues of simplicity and uniformity. And that gets down to Streamlined not telling states what they can and can't tax or what they should or shouldn't tax, but instead providing guidelines saying, again, if you're going to tax it, here's a definition to provide. If you're not going to tax it, that's fine, here's the definition to apply. And then also using technology as much as we possibly can to make that collection that much easier for retailers and especially the multi-state retailers. The effect of this ended up being the Streamlined Sales and Use Tax Agreement. The agreement itself was actually approved in 2002. It became effective October 1, 2005. So we are going on 10 years of active work and active participation by the states, and we know what the effect is of that, and we will talk about that. Our current membership, as of August 1st of this year, we have 23 full members, of which West Virginia is one, and then we have one associate member, who's Tennessee. So Tennessee has passed a lot of the legislation, but has not become effective yet. Therefore, they have done, I'm going to say, the minimum to become an associate member. Big difference between the associate membership and the full membership. Sellers don't have to agree to collect for the associate members if they don't want to. They can still register through our system. If you are a full member and a seller registers through Streamlined Sales Tax, through our central registration system, they have to collect the tax in all 23 of our full member states. There's a map that just kind of lays out all of the greenish colored states. Those are all of our member states. The red or orange, those are states that are advisory states. They are not full members. They have not passed legislation yet to enact it. And then you have Tennessee, who's the pink or purple, and that's our one associate state. Again, we continue to work forward now, and we will be focusing on having additional states join. We know, for example, Idaho and Missouri, those are two states that are looking very closely at this. Missouri actually had passed legislation to join, but because of the package that it was all included in, the governor ended up being in a position where he needed to veto it. So he vetoed it, and it didn't get back through. That was last session. We're hoping something else will come up again this session with them. Now, how does the Streamlined Sales Tax Governing Board work? How are we governed? All of our member states have a seat at our governing board. So when you join Streamline, you come in compliance with the agreement, your laws are in compliance with the requirements, you have a seat at the table in effect. So we have our governing board, that's who makes up our 24 state governing board. Then we have what we call the slackers, the State and Local Advisory Council. This is a group that covers not only the member states, but also other states that are participating in the project, but yet have not passed the legislation to join. We still want them to have a say in this. And the reason that's important is, again, it brings another perspective in. And at some point in time, we're hoping these other states will join, so we want to make sure that they have a word in on what happens. And then the back, which is the Business Advisory Council, this is a separate group made up of strictly business participants, tax practitioners, and these folks, again, they will provide significant input into the direction and different ideas and paths that Streamline can look at going with respect to any changes of the agreement itself. This is the way our hierarchy is set right now. We have a governing board president. Our president rotates on an annual basis. It's a state legislator 1 year, it's a tax administrator the next year, and we continually rotate through in that manner. Our current president is Senator Deb Peters from South Dakota. Myself as the executive director, we then have a 10-person executive committee, and that executive committee is made up of delegates from the states that are members, and we have 5 legislators and 5 tax administrators on our executive committee. We try to keep that as balanced as we can. There's some various other committees that do work. I'm going to say much of it is done behind the scenes with respect to the agreement and the governing board, but nonetheless, obviously very important to us. The governing board itself, they're responsible for making any interpretations or amendments to the agreement. There is a 3/4 vote requirement. So when we have, and the only states that can vote on this are our full member states. So we have 23 voting full member states. If we are going to amend the agreement, it takes a vote of 18 yes from our states before we will adopt that change to the agreement. Something that we have been very aware of lately with respect to amending our agreement and forcing states to make additional changes is with the federal legislation working its way through Congress. We are trying to do as little as possible in the way of making states make additional changes now. Until we know what that federal legislation ultimately says, we want to be very careful of making states want to change something that they may have to change later or change again when the federal legislation passes. The governing board is also responsible for certifying our tax technology systems and our service providers, and we'll talk about what those are and who those people are. Each year, our states go through an annual compliance review. West Virginia, just like all of the other states, had to submit their certificate of compliance and a letter indicating that they're still in compliance with the agreement, along with a detailed listing of where their laws bring them into compliance with each of the requirements of the agreement. And those go through, that review happens on an annual basis. So we are going through that process right now. It begins August 1st of each year. All of the administrative mechanisms are covered by our governing board. We have contracts with our certified service providers. Our governing board looks at those, reviews them, and approves them as a group. So our states that are affected by them are the ones that are voting on and approving or not approving those contracts. And then obviously with respect to the dispute resolution, they handle that as well. And again, the dispute resolution, although it's done at the governing board level, it's done with a significant amount of input from the business community as well, explaining what the different consequences are of different resolutions to different questions that come up. I do want to make sure that I point out to you that the Streamlined Sales and Use Tax Agreement does not trump your state law. So even if you're found to be in compliance with the agreement and you are a member state, if you have something in your law that is inconsistent with the agreement, your law still controls. But those are the issues that end up getting raised as compliance issues or compliance questions, whether it's by my staff when we do the internal review, or it's by the business community when they do their review on an annual basis of each state and each state's compliance to the agreement. But I think it's important for you to understand that your state law is still what ultimately controls. The agreement is your guideline, but again, it's your state law that's going to control ultimately whether or not something is risen taxable, et cetera. State and Local Advisory Council, again, that was one of our other groups in the governing area. Again, this is the main voice for the states that aren't participating in the governing board. We have a chair and a vice chair, and again, these are 2-year terms that these people serve. So Tim Jenrich from the state of Washington, tax administrator there, is our current chair. His term is up. Allison Jarris, another tax administrator from South Dakota. She'll be moving into the chair position, hopefully at the elections at the end of this year. This group is really the one, I would call this our worker bees. And wouldn't you say, Senator Harper, that's the best way to put that? They develop new definitions. If there's new definitions that are getting added to the agreement, this is the group that works on developing that definition. They really get down into the weeds. And if you've never had the pleasure of participating in a state and local advisory council meeting, I would certainly encourage you to at least participate in that, and you'll know the thought and the discussions that have gone into developing each of these definitions. Now, definition and request for definitions, a state can bring that request forward, a member of the business community can bring that forward, but we're going to look at it as a group and try to come up with a uniform definition if we believe that should move forward. And the State and Local Advisory Council and Business Advisory Council, they work very closely together as they're developing these. Again, this is the information about the Business Advisory Council. And again, businesses, associations, tax practitioners, et cetera, they're all involved with the Business Advisory Council side. Another committee I just want to mention is our Compliance Review and Interpretations Committee. This committee really, the role that they serve or the process that they go through is if somebody raises a question about how the agreement should be interpreted. In particular, if they've gotten different answers from 2 of our Streamlined member states on a uniformly defined term, the Compliance Review Interpretations Committee is going to want to look at that and develop a uniform recommendation to the governing board. Ultimately, those interpretation requests go to the governing board for final approval. The CRIC Committee or Compliance Review Interpretations Committee, they just make a recommendation to the governing board itself. They also are responsible for running the hearings for the annual recertification of the member states. So I mentioned that each state has to do their recertification by August 1st, indicating how they're in compliance with the agreement or how any law changes didn't take them out of compliance. The CRIC committee is the one that is ultimately going to be the one to make the recommendation to the governing board as to whether or not a state is or isn't out of compliance. Talk about some of the best practices in the agreement. One of the main things that Streamline does is creates or promotes greater uniformity across the states. Now, the greater uniformity obviously makes it a lot easier to administer and helps improve the voluntary compliance. The easier something is to administer, and the easier it is for people to understand what is or what isn't taxable, the easier it is going to be for them to make sure they remit the correct tax to your state, make sure they collect the correct tax from their customers. The other thing that this uniformity does is it really provides an infrastructure of support for all the states with a particular uniform provision. You're not going it alone anymore. You're doing it along with 23 other states or 24 other states. And by working all together, you're going to come up with, I'm going to say, the best possible system that we can have. And we're going to have support and a basis for the positions that we've taken. Second thing is using technology. Technology is out there, and technology can do wonders in removing the burdens that are placed on retailers for determining what's taxable, what's not, what the proper rate is for sellers within your state, and also for sellers that are located outside the state and selling products into your state. You want those remote sellers to collect the same amount of tax or the correct amount of tax just as much as you want your remote or your in-state sellers to do that. The other thing is that our best practices really shift some of the responsibilities to states. There's a lot of information that states have that we believe it's important that they put out there to the retailers, put that out there to the business community, put it out to the consumers so they know what's taxable, what's not taxable, what's exempt, and provide as much guidance as possible. Do you have anything you wanted to add on this?
No, you're doing fine.
Okay. So I would just ask, this is just, again, some history on Streamlined, where we've been, what our principles are, how we're operating, et cetera. So any questions that you want to ask me at this point? Otherwise, we'll get into what some of the key features are of the agreement itself. Okay, so let's move into what the key features are of the agreement. I brought a copy of the agreement with, right now the agreement is up to about 200 and some pages with all the amendments, et cetera, to it. But we also included in there is a historical perspective of what we changed, why we changed, and when those changes became effective. Key features: state level administration of the local sales and use taxes. This is a key from a business perspective, is to have the state or a single entity. If the state doesn't want to do it, it can be some other single entity, but administering both your state and your local taxes. The reason for this is this way businesses and consumers can go to one person or one jurisdiction or one location to get answers to their questions, one place to file their returns, one place that handles any audits that are going to be conducted. So you need that central administration. The common state and local tax bases within a state. If you want to exempt something, go ahead and exempt it, but exempt it at both the state level and at the local level. If you want to tax it, do the same thing there as well. Tax it at both the state level and the local level. We use uniform destination-based sourcing rules for all products that are sold. Destination-based sourcing basically is you're going to tax the product based on where the customer receives it. So if somebody orders a product that's located in West Virginia, and they order it from a retailer that's located outside of West Virginia should be the state that is entitled to that tax, because that's where the customer received the product. That's what all of the states follow today on interstate transactions. They use destination-based sourcing. And again, this is also driven somewhat by the court cases that have taken place over the years. We feel that's the proper way to do it. It's consistent with what you do from a use tax perspective on your consumers. If the consumer doesn't pay tax and they receive it in your state, and they didn't pay the tax to the seller, they have to pay that use tax directly to your state, or are supposed to be paying it to your state. Now, there is an option for states if you want to use origin-based sourcing and tax it based on where the product is shipped from. You can do that on your intrastate sales. But that's going to put your in-state retailers, that's going to make them run basically two systems. One for your intrastate sales, where they're going to tax it based on where they're located, and one for their interstate sales, where they're going to have to tax based on where they ship the product to, assuming they have nexus or a collection requirement outside the state of West Virginia. Some other key features: no caps and thresholds. This is something that drives retailers, I'm going to say, absolutely batty. If you have a transaction where you're going to say, okay, if you sell a product that's over X number of dollars, you can exempt the first $100 of it, that's something they have to try to figure out a way to program in their system. And many times when that is done on a product-by-product basis. So imagine yourself in the retailer's shoes trying to handle caps and thresholds of all kinds of different products at different caps and thresholds. Our agreement basically does not allow caps and thresholds. There's some exceptions when you get into some sales tax holidays and things like that, but generally there are no caps and thresholds that will be allowed. Rate simplification: you have one rate per state, but then you can also have a second rate on food and drugs, and each local taxing jurisdiction can impose their own rate as well. Keep in mind, the more local jurisdictions that you have, and one of the things I'll talk about is a rate and jurisdiction database, the more local jurisdictions you have, the bigger your database is going to be. There are states, I will tell you, that have to go down to an address level to determine what the proper rate is. And those databases are put together, and we have some of those databases in use in some of our member states. So it can be done, and the technology can handle that. But it is something that does cause additional complexity. With respect to the rate and jurisdiction databases, basically what this does is it matches a rate to every state and local jurisdiction. It might be by 5-digit zip code, it might be by 9-digit zip code, or it might be all the way down to the street address. You know, I can tell you when Wisconsin did this, and we have had a number of proposals to allow a lot of local taxes, local sales and use taxes, And one of the reasons that they don't go forward with them is because of putting together this rate and jurisdiction database and the complexity that it causes. Our rates in Wisconsin, our local rates, you do not have to go down below the 9-digit zip code. So there is no rate in Wisconsin that crosses a 9-digit zip code. That's a decision that, again, each state needs to make as far as how granular they want to make their rates and their jurisdictions. The database itself, to become a member of Streamlined, you have to have a rate and jurisdiction database put together. West Virginia has a rate and jurisdiction database, and it assigns the rate based on the 5-digit and 9-digit zip code. And again, any other states that want to join are going to be in the same boat. Now, there are hold harmless provisions. It says, look, the state put together the rate and jurisdiction database, they provided it, and if retailers use that rate and jurisdiction database and it ends up calculating the improper amount of tax, that retailer is held harmless. In effect, they follow the rules that the state asked them to follow, and it came up with an incorrect answer, so until the state corrects it, that retailer would have liability relief in those situations. There is a due diligence provision, though, where the retailer needs to show that they tried to find the proper rate. The other thing is, with respect to the rate and jurisdiction database and the hold harmless provisions, it does not apply to your over-the-counter sales. So if you're sitting in a store, you know what the proper rate is at that location. It's mainly when you're making deliveries throughout the state. Another key feature of Streamlined is our central registration system. This is a place where a retailer can go and they can register at one time for all 24 of our member states. So instead of having to go to each state individually, you register in our central registration system. Our system then pushes that information out to each of the member states. Now, we gather enough information to identify who the retailer is. We have their ID number, whether that's a FEIN number, a social security number, and we assign them a Streamlined Sales Tax project identification number. So they can have that, and that same number applies in all the states. If states want additional information, and I can tell you there are states that ask for things that get down as granular as give me the driver's license number of your general partners. There are states that want that. We aren't gathering all that information because there's a lot of states that don't need it, don't want it. But if you're a state that wants that, you can reach out then. You'll have enough information to contact that retailer, and you can reach out to them and ask them for that additional information. But then that becomes incumbent on the state to reach out to get that information. Any federal legislation that goes forward, we just see that it's inconceivable that federal legislation that would give every state remote seller collection authority can happen without having a central registration system. Because what's the first thing that every retailer is going to have to do if they're shipping things throughout the country? If you don't have a central registration system, they're going to have to reach out to each individual state and fill out a separate application just to say, you know what, I might be making sales in your state. This provision and this requirement allows them to register, again, one spot for all the states. We are in the process right now of, I'm going to say, re-engineering, redeveloping our central registration system. Our current system can only be used by our Streamlined member states. The new system will be available for use by any state. Any state that wants to use it will be able to gather that information and allow their retailers to register using our system. Our taxability matrix, this is a requirement that states fill out a taxability matrix. It's basically, as it indicates, quick and easy reference point on the state tax treatment of selected items. This does not identify every product that every retailer sells and tells them everything that is and is not taxable. It does not get down to UPC categories or UPC level, individual product level. What it does is it gets down to general product categories. So it says, do you tax pre-written computer software, yes or no? Do you tax pre-written computer software delivered by load and leave? How about by delivered electronically? How about by shipping them a CD? So it gets into that granularity. And again, it's in areas that primarily are handled or run into by remote sellers. But it's also things that apply to your in-state sellers. There are hold harmless provisions here as well, similar to the rate and jurisdiction database. If a state fills out the taxability matrix and indicates something is exempt, when in reality it was taxable, in that situation, if that retailer relied on that taxability matrix to tell them, don't charge tax on this product, and they didn't, the state would have to give them liability relief in those situations. Simplified electronic return. This has been something that has worked very well, and we've got a lot of positive feedback. It's a uniform return that basically provides enough information for a state to take in the money that a retailer collected on your behalf. It's going to let you know who that retailer is. It's going to let you, if you have local jurisdictions, they have what we call FIPS codes, Federal Information Processing System codes, that will tell you which local jurisdiction that tax was collected for. So it will break down your state tax and your local tax. I think earlier on, one of the presentations, there was a question about whether or not the Revenue Department could provide information about how much tax was collected at the local level. Using the FIPS code, if your state is gathering and using that information, you should be able to tell that. Those reports should be there, because when the retailer files a return, they put that FIPS code down for which local jurisdiction that tax was collected. Again, the simplified return, we are making it so that it's available not only to your remote sellers, but also your in-state sellers. Again, a simplified way for them to get the tax paid over to the Revenue Department that they collected. You still have all the opportunities if your state chooses to audit somebody to get all the details behind it, but does all that information need to be reported up front? So that's the question. And Streamlined came to the conclusion that no, it didn't. You just needed enough information to provide the state so that they knew who the money was coming from and where it was supposed to go. Uniform definitions. You know, every time people talk about uniform definitions and I hear the word candy, I kind of cringe. That was something that I actually worked on drafting a rule for Streamlined with respect to candy. And it is, you know, you get down into the weeds with it, and you have a Snicker bar and a Kit Kat bar. Are they both candy bars? And the answer is no. The Snicker bar is a candy bar, but the Kit Kat bar is not. And the reason it's not is because it contains flour. Now you might say, flour, how did you come up with that? Retailers wanted a bright line test. And how much more of a bright line test can you have than, say, look at an ingredients label? If it's got this, it's candy. If it doesn't, it's not. That's how they got to the distinction of whether or not something has flour. So if you want to avoid tax legally, if your state does not, if it taxes candy but does not tax food, I suggest that you eat Kit Kat, eat some licorice, and eat a lot of cookies. That's what I've been able to do. But otherwise, you have those types of distinctions. But those are when I said that Streamlined gets down into the weeds, this is what I mean by that State and Local Advisory Council gets down into the weeds. But they don't get down there alone. They get down there with the business community. Imagine a business that's operating in all 50 states. Sure, you've got 5 states with no sales tax. Okay, that makes it easy for them, right? But then you've got those other 45 states that have a sales tax, and each one says, we tax candy, but we don't define it the same. What are they supposed to do? They have to go to each state individually and figure out, okay, is this Kit Kat bar candy in this state or not? Is it in the next state? Is it in the next state? By the uniform definitions, that makes that sort of uniformity makes it much easier for those retailers. That's why as we're developing and you look at almost all of the definitions that are out there, these are areas that cause a lot of consternation by business as far as trying to make determinations on what is and what isn't taxable. So
One of the things that we did with Streamlined, and this was during the early 2000s, is we traveled all around the country at least once every other month and met in different states, talked with their businesses, and tried to go over these definitions here. And some of these meetings were absolutely brain-numbing, just as bad of a meeting as you could get, but we were trying to hammer out the issues in order to make sure that all transactions were treated the same and that businesses had their input into what was going on into this agreement. And it wasn't just the 24 member states that time. We had all the other states involved. They sent delegates, sent papers, white papers back and forth. This was a very good process for going through and bringing the business community, retailers, and governments together.
Okay. So this is a list of some of the terms that are uniformly defined in the agreement, and I would encourage you, you know, if you really have a hard time sleeping at night, it's a great place to start by reading all these definitions. Okay, so next thing, exemption administration and the good faith provision. I touched on this very briefly. Most of the states, before they joined Streamlined, puts some level of responsibility on their sellers for policing whether or not a purchaser was entitled to a sales tax exemption. What Streamlined did is they said, look, if you are a purchaser and you go make a purchase from a seller, and that seller does not collect tax because you gave them an exemption certificate, you told them, I am exempt from tax, or this transaction is exempt from tax. As long as that seller does not have knowledge, there's no fraud, they're not soliciting you to claim an exemption, those sorts of situations. As long as they take that certificate, they don't have knowledge, clear knowledge that you should not be claiming an exemption, they can accept that. They would not be required to collect the tax on that transaction. But they have to maintain that information. So if you as a state want to go back to them and say, hey, you didn't charge tax whenever Joe came in and made a purchase, how come? Well, he gave me this exemption certificate. Now you've got the information to go back and contact Joe and say, hey Joe, why didn't you collect the tax? Or why didn't you pay the tax? Why do you think you're exempt? And then you can make that determination, either yes he is or no he isn't. The thing that I like about it, and I was part of my responsibility in Wisconsin when I was there was as an auditor. What I like about it is I now have that information. I know Joe's not claiming to be exempt. And I can go back to just Joe and I can find out all the purchases that he made without paying tax on. If you require your sellers to police each individual purchase, you might be picking up the tax for that particular seller. But how many other sellers did that same purchaser issue that exemption certificate to and is not paying tax when they should be? So I think it's a good result of basically telling the sellers, you can accept the certificate, but you have to maintain that information, you have to provide that information to the state as they request it. So that way you have the information necessary to pursue those purchasers. After all, if you can get that purchaser corrected, get them straightened around, realizing, okay, yes, I have to pay tax if that's the situation, you fixed it for all the sellers that purchaser was buying from, not just the one that you happen to be out there doing a review of at the time. The exemption information that's there, we have what we call uniform data elements. Sellers can gather that information electronically, so you don't have to have that piece of paper. You can keep the data elements electronically as long as it's got all the same information. It's going to have everything that was on that piece of paper except no written signature. That's going to be the big difference between the two. Some of the other key features, uniform treatment of bank holidays. This way retailers know that, hey, if it's a bank holiday, it's a bank holiday in all the states. We want them all to be the same. Sales tax holidays, there are specific provisions in our agreement that if you want to have sales tax holidays, you can have them, but here's certain provisions and certain things that we ask that you follow when you do that. Uniform drop shipment rules, uniform rules for bad debts, and a uniform rounding rule. Just point out that bottom one, the uniform rounding rule. You would be surprised, and I was very surprised, that there are different ways that you could round how to compute the amount of tax due on a transaction. Most people would use the 3 decimals, anything that's a half a penny or more, you round up. Anything that's less than half a penny, you round down. There are states that say if it's a tenth of a penny or more, you round it up. There are states that say if it's anything over a penny, you round it up. This is a provision that actually kept some of the states from joining Streamlined because of the fiscal impact. When you think of all those pennies on every transaction, it was tens of millions of dollars in one particular state. Because of that, that was one thing that, because they knew they were gonna have to make that change, that was something they said, look, it's got a fiscal impact, we can't do that at this point in time. And we recognize that. I look at something like the rounding rule and say, is that something that we should really require? Is that something that if that's keeping a state out, should we look at relaxing their standards on that, but at least make them explain in writing exactly how they want it rounded? If it's something that the retailers can program into their system, I think then it's something worth taking a look at if technology can handle it. If not, then I think we need to really look at it and say, no, we need to keep the uniformity in this area. Now, I mentioned certified service providers a couple different times. We have different, what we call technology models. We have a Model 1 seller. These are sellers that use the services of what are called a certified service provider. What this certified service providers do is they provide what I call cradle-to-grave tax services. What this means is they basically take care of everything from computing the tax that's due on a transaction, calculating the tax, preparing the returns for the seller, filing the returns for the seller, making the remittances to the state for the seller, handling any audits. that are done by the states for that seller. So cradle to grave, they do everything with respect to that tax. You might say, okay, so these people are out there, what's it costing? We have contracts with 6 different certified service providers. We have 2 more certified service providers that I'm going to say are in the hopper. They're going through the certification process. We allow, as Streamlined member states, we allow the sellers to use these people at no cost for any of the states in which the seller is a volunteer. So let me give you an example. You have a seller that's located in Wisconsin. They're registered through Streamlined. They have no physical presence in West Virginia, but they make sales into West Virginia. They ship products here. They have to collect West Virginia tax because they registered through Streamlined. That's going to be a requirement for them. If they use the certified service provider has software and the programs necessary to integrate their system with the seller's system to calculate the tax, prepare the returns, etc. The CSP is in turn paid by being allowed to keep a percentage of the tax that they have to remit to West Virginia, in this case, on a volunteer basis. We have a contract set up with them. That contract will allow them to keep no more than 8%, and it's graduates down based on the amount of tax that they collect as a remote seller. So we enter into those contracts, they're allowed to keep a percentage of it. You as a state don't have to actually pay anything other than allowing them to keep a percentage of the tax. But it's only volunteer tax dollars, so it's only what I would call new money. It's dollars that you're not collecting today that retailer is not collecting. So you don't have to worry about, okay, if we do this, does this mean we're gonna have to end up writing a check to these CSPs? And the answer is absolutely not. When they file the returns, they actually take that allowance right on the return. So you know exactly which companies they're taking an allowance for. You can look at them and say, this isn't a volunteer seller in West Virginia, or yes, this is, and they're correct in taking it. But those are things that you can watch for through the Revenue Department, and many of the Revenue Departments do that. As of August 31st, as of today, there are over 600 companies that we have using these CSPs for our Streamlined states, for our 24 Streamlined states. In addition to the 600 companies using the CSPs, we have a total of over 2,600 retailers voluntarily collecting tax in all 24 states, regardless of physical presence. That number continues to grow on a month-by-month basis. Moving quickly through, I want to get over to some areas to watch as far as state laws, and if you're going to make changes to your state laws, some things that you really need to keep in mind so that you don't have, I'm going to say, compliance problems with Streamlined. I can tell you that by being a Streamlined member state, based on the numbers that have been reported to me by West Virginia, you're bringing in about $4.7 million from Streamlined registered retailers. Again, that's based on the numbers that are reported to us. And that is 100% voluntary. There's not one retailer that's out there that is told you have to register through Streamlined. It's people that have come forward, voluntarily registered, agreed to collect the tax because of the simplification, because of the uniformity. These are the main areas that I would watch for, because I can tell you these are the areas that the business community watches for when states make law changes, if they're Streamlined states, to make sure they stay in compliance. The uniform definitions. We have a section in our agreement, section 316, that deals with exemptions, that explains what you can exempt or how you can exempt different things, whether it's a product-based exemption, entity-based exemption, or use-based exemption. I would encourage you to keep an eye on that. The uniform state and local tax base, this is a big one for the business community. And then obviously the sales tax holidays and digital products. With respect to digital products, I heard in the earlier presentation that you don't have a definition right now in your statutes dealing with digital products. Streamlined does have definitions with respect to digital products. And our member states that are imposing tax on digital products are using those definitions. So I would encourage you to keep an eye on those as much as you can. And if ever you have questions, if you're looking at some potential law change and you're wondering, okay, is this going to cause a compliance issue for Streamlined or for us joining Streamlined, I'd reach out to your Revenue Department first. They're going to probably be able to give you an answer from knowing your laws very, very intimately. But if you want to answer directly from us, feel free to reach out to me. Let me know. Say, here's a proposal. Is this going to cause us any compliance problems? We'll be more than happy to take a look at it for you. Or we may be able to suggest a way for you to work your way around it, to get to the same thing that you're trying to accomplish, but be able to do it in a manner that's consistent with what's required in Streamlined.
Okay, Craig's gone through and given a pretty good review of what the Streamlined Sales Tax Agreement is and what it means to states. Let me personalize this a little bit more. Again, as I indicated before, I got into this not for the revenue issues, but for the state control of our own state tax policy. And also, I believe that we should, fundamental principle is that we should treat every taxpayer in every transaction the same. And right now, the way that we handle nexus versus non-nexus based transactions is not being done there. There's a number of states, including Utah, that have taken a position that we really are not, that the revenue is not as important as the policy issue. 2 years ago, I passed a piece of legislation that says that any new revenue from remote sales tax collection will go into restricted account, and then each year we'll take a look at it, and we will adjust our sales tax rate downward. We have Ohio, we have Wisconsin, we have Idaho, we have a couple other states that are doing that, planning to take the revenue when the federal bill passes and reduce their sales tax rate. I did back in 2012, when we were in a budget decrease, we were getting in about $6 million a year, $5.6 million a year from remote sales tax collection. I did go through when I was chair in the House there, we appropriated the money and put it into a 1% cost of living increase for state employees. First time they'd received anything in 4 years because of the economic downturn. Beyond that, all the new money will go into this restricted account. Again, it's an applicability. There's studies out there that shows that Utah is losing about $180 million a year from the tax evasion from people not filing their use tax returns. Average, about 1.2% of every people who file an income tax return remit their use tax. The estimation for West Virginia is about $103 million. This is not a partisan issue. If you take a look at the people who have been presidents of either current or past presidents of Streamlined Sales Tax Governing Board, former Delegate Doyle was the only Democrat. Myself and all the others are Republicans. So we bring everybody together on this issue in order to make sure that the states have a say in what they're doing. Our intent right now is to make sure that the federal bill passes and that we can go through and continue taking care of our tax policy as each one of our chambers chooses to do.